We had a very good performance for Mansa-X in the second quarter of this year. The Kenya Shilling Fund returned a return of 4.99% for Q2, and the Dollar Fund had a return of 2.93 quarterly return for the second quarter. The first half of this year for the Kenya Shilling Fund at 21.22% net of fees compares very favorably to the 17.38% for the first half that we delivered for Mansa-X last year. Essentially, this first half year, the first half of this year returned almost 4% higher than we returned to our clients last year, net of fees. The Dollar Fund this year, so far, first half of this year, has returned 12.82% annualized return compared to 12.38% last year. So for the Dollar Fund, not a very big difference, about 0.5%, but a considerable difference in the Kenya Shilling Fund, which has returned over almost 400 basis points higher than last year. This continues to be a very good value, therefore, for our investors over time, based on that kind of trajectory. So just as a demonstration of how tech companies performed, if you look at NVIDIA alone gained 36% in Q2 of 2024. Alphabet alone gained over 20%, but we also have we also have outliers as well, especially in the pharmaceutical industry. We are talking about Novo Nordisk, which gained about 11%, and Eli Lilly, which gained about 16%. We also had good performance from financial services companies like JP Morgan Chase and Goldman Sachs, which gained, most of them. JP Morgan Chase gained 1%, but Goldman Sachs about 8%. So now we can go through the top 10 holdings for Mansa-X Fund, both the Kenya Shilling Fund and the Dollar Fund. This information can be found in the most recent Mansa-X fact sheet for Q2 2024. This is a lot more detailed, but we can quickly go through the top 10 holdings for the Kenya Shilling Fund. I'll just go through some of them because I've already discussed most of them. The top 10 holdings, we had fixed income instruments. Now these ones range from African Eurobonds that we hold on our books to US Treasuries and some German bonds, and any number of interest-bearing assets that are held in our books. This is what we refer to as fixed income instruments. These constituted about almost 6% of both funds, both the Kenya Shilling Fund and the Dollar Fund. We were also heavy in the US stock markets through exposure to NASDAQ and the S&P 500. Like I mentioned earlier, NASDAQ gained about 8% in Q2. S&P gained about 4% in Q2, but had been having a very good run for the first half of the year, where it had gained about 15% year to date. So those two, fixed income and NASDAQ, were mostly long positions. We were also holding a short position in the Japanese yen. Year to date has lost about 14%, but specifically for Q2, lost about 6%. Again, this is a position we held in both the Kenya Shilling Fund and the Dollar Fund. We hold positions in interest rate derivatives. The reason we do this is really just to create exposure in interest rates, whether up or down, using derivative contracts, and then we squeeze out a return out of those. For the NASDAQ and Japanese yen and interest rate derivatives, we are talking about an average of 5% holdings in the notional value against the total AUM of the fund. We were also holding a significant short position in sugar. If you look at sugar, in Q2 alone, it lost about 10% of its value. And in both the Kenya Shilling and Dollar Fund, slightly above 4% exposure against the total AUM for the fund. Of course, a top performer for us, and has continued to be for the last 2 quarters, is NVIDIA Corporation. That was a big gainer, especially in the Kenya Shilling Fund, gaining 36% in Q2 alone, which is quite significant. Alphabet as well, about 20% as well for the Kenya Shilling Fund. In the dollar fund, again, back to the Kenya shilling fund, we had Novo Nordisk, has continued to be a very favorite stock for us to hold, and this one gained about 11% in Q2. And in the dollar fund, we had Eli Lilly, again also a pharmaceutical company, which gained 16% in that quarter. Exposure to financial companies, we also had JP Morgan Chase and Goldman Sachs. JP Morgan gained about 1%. Goldman Sachs gained 8%, so performed much better than JP Morgan, but this was in the dollar fund. So our holdings in the dollar and Kenya shilling funds tend to be very similar in terms of sectors, but companies might vary, mostly also because of entry points, because you don't typically enter positions at the same time. So even if you are favorable, say, to the pharmaceutical industry, you might get into different companies, but with the same with the same reasoning around why you should buy that stock. But it can then lead you to having more holdings in one particular company over the other. That's part of the reason why the top 10 holdings might be different, but the sectors tend to be largely representative of the portfolio management strategy that we have at any one time. So in the second half of 2024, we might see increased volatility. I mean, we've had a very low volatile environment in the first half of this year. I mean, in fact, I'd say it's one of the lowest volatility environments for trading we have experienced for about 10 years. So in the second half of this year, we expect that because of political tensions, especially now in the US, volatility will increase. We're already seeing it. We're already starting to sense increased anxieties in the market, where both sides of the divide are both very certain about who will win, especially now with a new candidate for the Democrats that has just been recently introduced. So we expect that there's going to be a lot more uncertainty, and this might increase volatility for the fund, but we remain data dependent. We'll be looking at actions of the Fed, guidance from the Fed. We expect interest rates might start being cut as early as the end of Q3 this year. So we'll be really watching data, including CPI data for inflation, jobs data numbers, just to give us a guide on what the Fed might actually do moving forward into the second half of this year. But we still remain relatively bullish on stocks, mostly first because we expect interest rates to be cut, and most importantly because we expect earnings to remain elevated. For the reasons I stated earlier, that most companies, on account of having cut their spending, continue to have better than average earnings as expected by the market. In fact, 79% of companies in the first half of this year performed better from an earnings perspective than they were expected to. That's quite significant, and we expect that this trend will continue. We also expect that the US Treasury, based on their own forward guidance, will most likely continue to borrow less. Again, we expect this will keep interest rates under pressure. So moving forward, we might get into a low interest rate environment, which again should keep the stock market bullish. And again, this is something that we'll continue to monitor based on the changes in the data that we receive. But again, as a fund, we are always open to changing the dynamics of how we trade based on any changing event at any one time. If you look at how the portfolio looked for the first half of this year, for a very long time, we had a very hedged book, but for the first half of this year, a lot of our stocks were mostly long positions. We'll be watching very closely how volatility will change the need for us either to continue that way or to see the need for a more hedged book to deal with increased volatility in the markets, so that it doesn't then end up infecting the performance of the fund. Locally, we'll be looking at I mean, if you look at the stock market and local bonds, we are already seeing an effect of the local stock market by the recent downgrade by Moody's, and we are waiting to see how the effect of this will be on interest rates. From a Eurobond perspective, we've already seen an effect where investors are demanding higher yields now for most Eurobonds, even the Kenyan ones. And this is something we'll continue monitoring in the second half of the year. The stock market had already been taking a beating as a combination of both a weakening shilling and also concerns around the local political tensions. So all this will continue to be something we monitor on a daily basis for the rest of the year. But we do feel that, especially for interest rates, we might really be at the peak of those, and we expect a gradual correction of yields downwards, as a lot of what has happened now has not only been priced in, it had also been it has already been traded, and now we're already having a lot of take profit activity in the markets, where most people who are holding bonds for trading purposes are already starting to cash in on their bonds. We might start seeing yields coming off in the second half of this year. And for the stock market, we'll be looking for activities that can create value. For example, we saw the recent probable delisting of Bamburi as one of the few events in the stock market right now that could probably create some sort of excitement, and we'll be looking at that also as a fund moving forward. So special thanks to our investors for sticking with us this whole journey. I mean, Mansa-X is now about 6 years old now, and for the period that we have grown, it's really because of the belief and trust we have from our investors, and we are happy that we've demonstrated the ability to give a return higher than average for that particular time. We expect this to continue. We expect that Mansa-X will continue to deliver a good return as long as we continue sticking with the strategies as we have from the beginning. And now we are very happy to announce that the CMA has finally recognized as a special collective investment scheme, and we've officially been licensed as a first special CIS in Kenya. And we are actually also there for the biggest, now managing almost 35 billion in combined assets. This is something, again, would not have done without the support of our investors. So thank you very much once again, and it is our hope and expectation that moving forward, Mansa-X, both the Kenya Shilling Fund and the Dollar Fund, will continue to deliver above average returns. As you might very well know, we also have a Sharia version of the two funds, the Kenya Shilling and the Dollar Fund, which also performed very well the first half of this year. And we will be putting out a YouTube video just like this one to again take you through how and why they performed as they did, and again to then explain to you the key assets that are held in those funds. So thank you once again, and looking forward to better performance moving forward.